Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 3:30 in New York. It is Monday, December 28th, 2015, and this is the Daily Report for Gold and Silver, coming to you on our last week of trading in the year 2015. And to start it off, we do have the majority of the precious metals complex lower today, commodities as a whole lower today, equities lower today. First to gold, as you can see, trading off over $8 on the day, 1067, right off of a low at 1066.70, the high 1077. So we still have a very narrow range. We're going to have reduced volume as we do have a shortened trading week this week, and traditionally the time between Christmas and New Year's is a very, very light trading activity. We're going to use this week ahead to really go through our strategy and our game plan for the upcoming year 2016. So traders, as I have said, I do want to use this week to really go and outline our strategies for the upcoming year 2016 in terms of what we're looking at, both short-term and medium-term, in terms of our actual forecast. Before we do that, let's take a look at gold, see where support and resistance currently lie, and determine whether we're not at a critical point in the market. So to do that, I've gone ahead and I've pulled up this chart, a simple daily chart, standard candlestick format. And on this chart, I basically have one fib retracement. Now, this fib retracement itself goes from these lows right in here at 1046. So it starts really 1046 and goes up to the high that we hit back in September, which was around 1191. Of course, we had another high above that, but that is not a price point that I really think gives us any kind of real good information. When we do that, we get our different fib levels. And the critical level that we're looking at in terms of support right now comes in roughly at 1062. That's a 61% retracement of this entire move here. And you can see where it did provide some support at certain points, but the market's genuinely been all over the board in terms of this particular price point. When the market first came down at the end of November, you can see it attempted to hold that, came down, and that's when we actually formed our first of this double bottom. We'll see if the bottom holds, but as it came back up, we hit these highs, this being at around 1091, and then this being at around 1080. And so our resistance points in terms of short-term views of the market have to be this next level right here. And this level here, of course, would be a 75% retracement at 1083. Now, in terms of some of the other technical indicators that might give us a little bit of indication as to where this market's going, I draw your attention to this one moving average. It is a blue line, dash blue line. You can also see that we are currently trading just underneath this particular moving average. This moving average here is roughly a 50 cycle, but it's a 50 cycle off of a half a day chart. So you're looking at a 25-day moving average. So we have broken below that. And the other thing is the MACD, and let's go ahead and pull that up. In fact, let's try to blow this up a little bit. And you can see that after taking this market, we've definitely got a cross coming in, which is a sell signal of sorts. And so now we're simply looking at the corresponding candlestick patterns to kind of give us an idea of where to enter the market. But as I said last week, any rally at this point should be looked at as a point to go and strategically sell this market. Now, although I do believe that there is some real potential for further erosion or decline in gold prices from here throughout the remainder of the year, the other thing that I believe is most noteworthy is that I am not expecting a tremendous move one way or the other, and I am expecting gold to trade in a fairly concise and narrow trading band as we go into the end of the year. To illustrate that point, I have pulled up a 700 half a day Japanese average chart, and you can see that we've really been in this band of trading throughout December, as this market has struggled with these lows at 45 here and another low here at 47. But when you look at the candle color itself, let's go ahead and just kind of blow that up. What we can see out of this is that we get this alternating candle color. You've got red, green, red, green, red, green. Although here you had a little bit of a rally, but again, congestion. And when you consider when this market actually rallies or when it actually corrects, you get an abundance of color. It's very, very clear with the Japanese average charts. And so it's very clear to me that we are in a consolidated tight trading range. For example, your downtrend, predominant red candles, uptrend, predominant green candles, sideways, combination of both. And so for that reason, it's going to take more than just a quick nudge, so to speak, to get us on the short side, because I don't want to get trapped in a market that doesn't really have a range right now and wait for a real trend to emerge, whether it's to go to new lows or to find a bottom. But I am betting on the first, not the latter. Lastly, I do want to take a very, very short look at what we are anticipating next year and price points and target dates that we're looking for gold to actually go to by what time. To do that, I've pulled up a weekly chart, and on this weekly chart, we have our basic fib retracement. This fib retracement goes from 700 up to 1900. We also have a bear channel, a linear regression that has been put in, which is obviously a cascading channel line that is biased towards the downside. The market has been moving down predominantly over the last couple of years. And as you can see, based upon this particular study, meaning the channel lines, we could go easily to 1,000, which is right here, and as low as 971, which is a 78% retracement. We're going to look in more detail at this chart and some other long-term studies as we conclude the remainder of 2015. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another update and review. Bye-bye.